China didn't just launch a digital currency. It unleashed a $1.2 trillion financial weapon, silent, precise, and meticulously engineered. Not to join the global system, but to replace it. While the world remains entangled in the antiquated spaghetti of SWIFT codes and dollar clearances, Beijing has been cutting itself free, quietly, methodically, for over a decade. Not with bluster, not with bombs, but with code, protocols, bilateral pacts, programmable money, a new monetary nervous system now stretching across 200+ countries and regions, already settling cross-border transactions outside the reach of the dollar. According to the People's Bank of China, this new architecture has processed over 1.88 trillion in pilot transactions, around $250 billion, as of Q1 2025. But this isn't about scale, it's about control. Because sovereignty is no longer just about flags and borders. It's about who owns the pipes that carry money through the veins of global trade. And China is building those pipes, quietly embedding the e-CNY, the digital yuan, into trade routes, supply chains, and central bank digital currency networks. It's not integrating into the global financial order. It's rewriting it from within. This isn't some shiny fintech upgrade. It's the first state-built infrastructure with the potential to rival, or even replace, the global SWIFT IBAN system. Martin Chorzempa of the Peterson Institute called it what it is, a serious, state-run alternative. In 1944, the US dollar emerged as king at Bretton Woods. In 2025, China is challenging that crown, not with confrontation, but with code, with programmable currency, with bilateral swap lines, with strategic precision. If this is China's monetary Manhattan Project, then what we're seeing now is just the scaffolding. The real structure lies beneath. Since 2015, China has signed over 41 bilateral currency swap agreements, worth $580 billion, a decentralized bilateral mesh that allows direct RMB trade without a single US dollar clearing bank. By late 2024, 38% of China's total trade had already migrated outside SWIFT. Those payments now flow through China's cross-border Interbank payment system, CIPS, linked to over 1,400 financial institutions in more than 110 countries. That means oil tankers from Saudi Arabia no longer need to wait for clearance from New York. No dollar, no delay, no American oversight. SWIFT still pushes 40 million messages a day, but its grip is slipping, especially across the global south. While the West debated inflation and interest rates, China built an alternative reality, an autonomous infrastructure for money movement, and it's already changing behavior. In March 2024, Kenya bought oil from the UAE in Yuan. Argentina, out of dollars, repaid a portion of its IMF loan in Yuan. The yuan's share of global payments has tripled in just 2 years, from 1.9% to 6%, according to SWIFT's own. This isn't de-dollarization driven by ideology. It's de-dollarization driven by survival. When access to the dollar becomes a weapon, tied to sanctions, SWIFT exclusion, and political leverage, nations look for insurance. And China is offering a lifeline. A lifeline with no correspondent banks, no compliance traps, no Western gatekeepers, just programmable sovereign currency, executed on a Chinese-built rail system that doesn't ask permission. But this isn't decentralization. It's a recentralization under Beijing. And that's the true question. Are nations buying independence or trading it for new dependency? Right now, that question is playing out in Indonesia, where small and mid-sized businesses are using e-CNY wallets to bypass dollar conversion delays entirely. In Malaysia, where the central bank has linked its own real-time payment system directly to China's, unprecedented in the region. And across ASEAN, where over a third of China's regional trade is now settled without the dollar. This isn't just a shift in tools, it's a shift in norms. As Alicia Garcia Herrero, chief economist at Natixis, warned, China isn't just exporting goods anymore, it's exporting rules. And once your economy runs on Chinese rails, your autonomy becomes conditional. Because if Beijing controls the rails, what happens when it wants to control the routes? CIPS now processes over 83 billion daily. This isn't a pilot, it's operational, programmable, potentially unilateral. And that brings us to the chilling question, who holds the kill switch? In late 2023, a test between Hong Kong and the UAE settled trade invoices in seconds. Costs dropped by 98%, according to the Bank for International Settlements. SWIFT, in comparison, only transmits messages. China's system moves value in real time. No third-party clearing, no FX delays, no waiting. As Josh Lipsky of the Atlantic Council put it, China isn't just building a faster train, it's removing the ticket booths and owning the stations. Since Russia's SWIFT cutoff in 2022, CIPS volume has surged over 90%. China has expanded digital yuan swap lines with Brazil, Pakistan, Saudi Arabia, all dollar-strained nations. Even close U.S. allies, Indonesia, Egypt, the UAE, are quietly testing yuan-denominated trade. This isn't the future. It's already here. And it's not loud. It doesn't need to be. Because revolutions that succeed don't always start with a bang. Sometimes they begin with a whisper, coded in a protocol, settled in milliseconds, and designed to rewrite the world. The more the United States turns the dollar into a weapon of compliance, that's the warning from Eswar Prasad, and the contradiction at the heart of America's strategy. Washington's instruments of financial power, designed to enforce dominance, are now accelerating the very systems meant to bypass them. Each sanction doesn't just punish, it provokes. And what it provokes may be the next seismic shift in global finance. If innovation is born of pressure, then don't look to Wall Street for the next breakthrough. Look east, to Shanghai, to Shenzhen. The Belt and Road Initiative has already funneled over $1.1 trillion into infrastructure across 148 countries. But this isn't just about roads and railways anymore. What connects these nations isn't only concrete or cables, it's currency. Control of it. Across ports in Kenya, terminals in Pakistan, and high-speed lines in Laos, payments are no longer settled in dollars. They're completed in e-CNY, digital yuan wallets issued and monitored by China's central bank, the PBOC. Bloomberg confirms at least 13 Belt and Road nations are now experimenting with yuan-based digital settlements. But this isn't a test, it's an upgrade. Some of these countries are going even further, embedding e-CNY into smart contracts governing sovereign debt that is not just programmable, but recallable. A new logic is being hardwired into global finance. Money with conditions, execution with oversight. As economist Garcia Herrero puts it bluntly, China doesn't just lend. It controls how the money is used, where it flows, and crucially, how to take it back. So what are we looking at? Infrastructure or digital colonization? At the 2024 BRICS summit in Johannesburg, the answer came sharply into view. Member nations agreed to develop a shared cross-border payment system using central bank digital currencies, with China's digital yuan firmly at the center. 4 central banks have already launched pilots. SWIFT's own data confirms it. In parts of the global south, yuan usage now outpaces the euro. This isn't de-dollarization by collapse. It's fragmentation by design. And now, with BRICS nations like Brazil and Russia pushing for a joint settlement platform by 2026, the dollar's supremacy is no longer assumed. It's challenged, contested, uncertain, but in a future of many financial rails. Who governs the intersections? Then came the rupture. January 2025. A newly re-elected Donald Trump reignited the trade war with a thunderous blow. A 60% blanket tariff on all Chinese imports. But Beijing didn't respond with tariffs of its own. It responded with strategy. China accelerated the e-CNY's integration into its export financing system. By Q1 2025, trade settlements in digital yuan were up 19.3% year-over-year. State banks began offering exporters yuan-denominated trade credits at interest rates lower than dollar loans. Letters of credit in yuan are now up to 40 basis points cheaper in key markets than their dollar counterparts. China isn't fighting a tariff war. It's building a monetary firewall, one the US may no longer be able to breach. This isn't a trade dispute. It's a full-scale race to build the next global financial operating system. The dollar isn't disappearing, but its role as the gatekeeper of global commerce is being rewritten, not by senators or CEOs, but by algorithms, architecture, and infrastructure. While Washington argues over tariffs, China lays rails, embeds them in infrastructure, wraps them in trade deals, distributes them via wallets tied to its central bank. This is about more than savings or speed. It's about control, programmable disbursement, real-time surveillance, and the ability to shut off the tap if a nation strays too far from Beijing's favor. So when the next crisis comes, when liquidity is needed fast and Washington hesitates, will the world accept Beijing's terms instead? Because make no mistake, China isn't just preparing for the next financial war. It's positioning itself